Most financial gurus are going to tell you one strategy, and that is you buy term insurance and then you invest the difference, or whole life insurance is the only way. But here is the truth, Wealth Nation, because that debate is wrong, because the best strategies actually include both. My name is Carmen.
And I'm Darius. And the biggest myth that we have to break with our clients is the fact that term and whole life are competing strategies when they are absolutely not. They are two completely, well, what they do is they solve two completely different problems. Term is temporary protection, whereas whole life builds permanent structure and capital. So people argue about which one is better, and they actually asking the wrong question.
So let's talk about our specific story, because you need to understand how we put this into real life. So let's go through our own strategy. For example, Darius and I owned 7 whole life insurance policies. And on the surface, you may look at it and go, man, they got a lot of life insurance. They're completely covered. But when we actually looked at our numbers, we realized that we weren't checking some things that a lot of people miss. We were in the same boat. And that is, we weren't maxing out the most insurance that we could get. We're talking about death benefits. So let's actually run through what it means to understand this gap that we're talking about. Okay, so just because we have a lot of premium doesn't mean that we have enough death benefit to protect our income when we pass away. All right.
And I want to say that's the common thing that happens when using a strategy like infinite banking is because when you put a lot of cash value, or make sure you have a lot of cash value into your policy, what you give up is some of the death benefit. And we have 7 policies because as our cash flow increased, we bought more policies based on our cash flow into the permanence point that left a gap.
And the gap is the death benefit. So again, if you have children, if you have spouses and people who are going to be here when you're no longer here and you want to make sure that they have the cash, follow along. All right.
Because the last thing we want to do is to sell any assets ever. The last thing we want to do if anything happens to either one of us is have to sell an asset.
Yeah, because we don't have the cash flow. All right. So life insurance solves that for you. So here's really the difference that you all need to consider, because what we're talking about is what you currently have in protection versus what your income justifies. And at Wealth Nation, we use a really simple framework that's actually provided by the life insurance company so that we know what the ceiling is as far as how much death benefit we can qualify for. And we've talked about these numbers before on our channel, so I'm going to run through them quickly again so that you have them. But the idea is I'm going to show you your age and the you need to multiply your income by to determine how much death benefit you qualify for. All right, so listen up. We'll put this on the screen for you. If you are watching our video today and you are under 40, multiply your income by 30. If your age is 41 to 50, multiply your income by 20. If your age is 51 to 60, multiply your income by 15. If you are 61 to 70, multiply your income by 10. And 71 and up, I want you to multiply your income by 5. Now, Wealth Nation, let's be clear, this is not a guarantee because this is all depending on your ability to qualify for life insurance, all right? So don't be running over there talking about Darius and Carmen told me I can get this. Homie, you still need to do your medical exam, all right? Yes. So this just gives you a target so that you can understand your exposure or your gap. Right. So let's put a real life example to it so that we're all tracking, right? If you're watching this video today, you make $150,000 gross a year and you're 45, that means $150,000 times 20, which was your multiple because you're 45, that means that you should have $3 million of death benefit, or your economic value is $3 million. That's how we wrap that all up together, right? Now, here's the question you have to ask yourself, which is identifying the gap. Let's say today you have $1 million of life insurance, but using this example that I just shared with you, that means you have $2 million gap. We need to close that. So what is going to happen with the $2 million that your family is currently dependent on because your income is generating that right now? So that's the difference. That's the gap that we're talking about. So I want you to right now create a little example in your head and figure out what your own gap is. Now, let's start from scratch. Let's say that you're watching this and you don't have any protection whatsoever. So let's go through the cost. Because if I'm 45 years old and I need $3 million of death benefit, that means I have two options right now. I can get term insurance for 10 years, and that cost will be $4,000 a year to cover my income completely. Or you can get whole life insurance, and the cost for whole life insurance is $64,000 a year. That's the difference.
Right. And using those numbers, that's exactly what Carmen and I faced. We had two options. We could force everything into whole life immediately and overcommit on cash flow. Or option number two, which is to protect the full amount now and build into a whole life strategy over time.
Mhm. And this is where we want to suggest that you don't force the system, right? Because we could have filled the gap entirely and got whole life insurance. Yes, we could have done that. But the point is, like Darius mentioned, it would have required us to allocate a bunch of cash flow that we weren't ready to deploy up front. So instead of forcing it, we decided to sequence it. So in the numbers that we shared before, we decided to go with the $4,000 range instead of the $64,000 range, because what it allowed us to do is to buy term insurance and secure our entire income immediately, just like that overnight. And so we have full protection today, and we didn't compress the financial system, meaning our cash flow, and term doesn't replace whole life. We want to be clear with that. We bought term insurance with the intention of buying us time. And why did it buy us time is because we will never be cheaper to insure than where we were yesterday or today. So we knew we were still young. We still want to be able to leverage the fact that it's the cheapest that our insurance will ever be, and that we know we're buying time in the future so that we can convert the death benefit over time. So we can take pieces of the death benefit. Let's say it's the $3 million, for example. We could take pieces of the $3 million, a million here, a million there, or we could convert the whole kit and caboodle when it made sense for us.
Mhm.
And the point with our term insurance that we purchased, we wanted to make sure that we had strong conversion options, meaning we gave ourselves a 15-year window to convert. So we bought the time. So what I mean by that is we have a 15-year term policy so that our term goes on for 15 years, and it gives us that much time to be able to convert however much we want when it makes sense for us.
Right. And the next step is to scale into whole life. As our income grows and our system expands, we want to convert strategically. Because the thing about a system is that you don't have to do it all at once, and you want to make sure that it aligns with your cash flow.
Absolutely.
And a system also doesn't require our cash flow. We're just saying it requires cash flow. So we're building our system so that our assets create the cash flow where we can step aside. Because systems need us to start it, but it doesn't need us to finish it.
And the other thing to note is we're not delaying protection. How many of us are watching this video right now and delaying because we don't think we have the cash flow to get it now? So the point is, if you're watching this video, stop delaying protection because of affordability needs. It can be as affordable as you need it to be. You're just not speaking to the right people who can get you to where you need to go. All right. So if you want help, click on that link below so Wealth Nation can serve you, because it's all about securing your income first and then building performance over time. Because I know many of you watch our videos because you want to do infinite banking, and we're not saying not to. We're just showing you how you can build or buy a shoe that's a little big right now and then grow into it.
Mhm. Now, here's why this matters. Because if you've been thinking, I want whole life, but I'm not ready for that commitment yet, this is your answer. This strategy gives you protection now, time to grow into your whole life, and flexibility with your cash flow, along with your cash flow. And then number four, a clear, structured path.
And addressing the cost is something that we always want to make sure that we're clear with you, because again, cost is usually the reason why some people don't take action. So whole life does require financial commitment.
Mhm.
You got to be ready for it. And if this system isn't ready for your commitment yet, then let's not delay protection anymore. Or let's not force the issue and get you into something that you can't even afford from the beginning. Instead of avoiding whole life and delaying, let's use term while we can right now, because like we said, it's the cheapest that it's ever going to be, and build into a system that you can support long term.
In this video so far, we talked about all the pros of using this strategy. What are the cons? What is the risk that you face? And to be honest, the risk is you not executing the strategy. And that means you never convert your term. You buy a term and you never convert it. And another one is you buy the wrong term, meaning you buy a term that you can't convert into whole life.
Yep.
And what I mean by that is you buy a term from an insurance company that didn't even have a whole life product. That's where you can't convert it into whole life. And then number three is your income grows, but your discipline doesn't.
Meaning you're spending way too much money and you can't afford to buy the whole life insurance product in the beginning.
Right. And then the last thing is you treat term like it's permanent.
Hmm.
Term is a bridge. And if you never cross it, you stay stuck.
Woohoo, that's a good one. So at Wealth Nation, we're not just teaching you about products. We want to teach you about order. So here's the order that we're going to put on the screen that you should follow as it pertains to your money. First, you got to protect it. Then next is liquidity. Step number 2 is liquidity, meaning go make some more money, go get access to more money. Then you grow that money. Step number 3 is growth. And step number 4 is lifestyle. Then go live the life that you want to live because your money is protected, it's liquid, and it's growing, and you can live the life that you want.
Right. And notice how lifestyle is at the end. Lifestyle is the reward for managing your money correctly through these steps.
Yeah, so sometimes we get that mixed up. Yeah. So next, we want you to consider that with this whole process, term is going to help you protect, right? Whole life insurance is going to help you build. And together, you can create a system that can last a lifetime.
Mhm. If you're trying to figure out how to structure this for your life, don't guess. Just click on the link below.
So Wealth Nation can serve you. And remember to own your own lifestyle.
Or someone else will.